Okay, welcome back to another episode. Today we'll be talking about MNQH 2026, Micro E-mini NASDAQ 100 Index Futures, the March 2026 contract. We talk about the AM session. I'm going to give you some top-down approach things, some time-based things, and then some entry models to look at on days like this. And I want to preface this by saying the days that we're going to be looking at today are the one-sided days. So there'll be some days in the market where, from 9:30 to about 11 o'clock, you just see sideways price action, right? So I'm not referencing those days. I'm referencing days where you see a price return to a logical area, break down, and then races to another logical area, whether that be a inefficiency or liquidity. This video is strictly for educational and information purposes. Nothing discussed here should be considered financial, investment, or trading advice. I am not acting as your advisor. Any trades or examples shared reflect personal analysis only, and all financial decisions remain responsible. All right, so I want to show you a different chart today. All right, so this chart is my new week opening gap chart. So this is another chart that I will have open on one of my monitors for solely just plotting the new week opening gaps, right? So the purple line is delineating the present day or today's date new week opening gap for February 22nd. And as you can see, price ran up into that level, and then we begin to break off and trade back down. So what I'm gonna do is I'm gonna use this chart, and I'm gonna also use just the let me just go to it, this chart too. So I'll be working back and forth so you can see kind of like how I'm referencing both charts, present day and price action, and then how I am operating with that information based off what we do or what the chart does with that information. So the hourly chart again, we were here, right? So we're trading inside of this range here. So from that high to that low. Okay, we also traded inside of these inefficiencies here, that inefficiency, that inefficiency, that inefficiency. So coming into the day, I really didn't have a bias. Honestly, I just came in with price action. I knew we were consolidating, so I didn't have a directional overlasting bias for higher or lower prices. I knew I just came in, and then at 9:30 or 9 o'clock, essentially see where we at in price action, and then how do we trade at the open, and then I will look to get engaged in price runs, one-sidedness price runs, if price does show the ability to want to have some lift in the AM session. So again, like I was saying, this purple line is the present day new week opening gap, and I'm gonna get right into it. I'm just gonna drop down to the 1-minute chart so we can kind of see what's going on here. Let's plop this up a little bit. All right, so let's go back out real quick. I'm sorry, 15-minute. I want to show this fair value gap, and I want to show this this low. So really, what we can do with this low is we can grade it. We can calibrate it. 7:15.25 is the open. Visibility, I don't really want it on all of those. Let's just go there. And then the low comes in at 96.25. Whoa. The low comes in at 77 even. Okay, cool. All right, so we can take that, and then we can know that the 0 level on the fib is the sell side liquidity pool. So this low. So now we drop down to that Fibonacci level. Once we see the 0 level, we'll just also note that as sell side liquidity pool. So as we were up here, let's just look at it from a 15-minute standpoint. If price does decide to turn at this fair value gap in the form of an inefficiency, in the form of a new week opening gap, I'll probably hear something about that from ICT. This is clearly just a new week opening gap. All right, so from Friday's close to Sunday's open, that's the new week opening gap. You want to plot that on your chart. And then this is a previous week opening gap from February 15th. So as we're up here, if we start to break down inside of this range, the targets for price points or the targets for shorts, the first one will be the new week opening gap from February 15th. Then you could take the gradient level of this wick and then ultimately the low of that wick. All right, and then that will look like something like that, right? Coupled with a turning point up here, and we can make that also purple. So essentially, we look this current price fractal, this run up to come back down, is essentially what we're seeing here in this intraday price action model. So let's drop down into a 1 minute chart so we can get into the nuts and bolts of the AM session. Okay, cool. So here we have it. Beautiful day today. Honestly, let's scoop this Fibonacci back a little bit so we can see all of the levels before we trade in there. Cool. All right, so remember that zero level is the sell side liquidity pool or the best case scenario exit to trade out the entire fractal if we were something like this, right? And also too, I want to show you that you don't need that to completely run out to be profitable when trading the index futures contracts. Okay, cool. So we have the 930 open will be a vertical delineation. We'll drop a line on that there. Wow. Okay, and then let's drop it down to about here. All right, so this vertical dotted line is a 930 open here. All right, and at the open, you see us consolidating. We're just kind of just moving sideways here. Zoom in a little bit. Moving sideways here, but banging up into that present day new week opening gap, right? Failed to trade through it, have any legs to trade through it. All right, this is in what we deem as smart money as true support and resistance. This gap is being used as resistance. We didn't trade lower, right? And then what we have here is kind of how I guess you could say, if you look at all of my examples of me entering into the market, is in a form of something like this: a fair value gap, and then I'm gonna couple it with a swing high, right? And then you will see probably 2-3 models of that in this price run. So you see it there. If you didn't trust that and you want to see price then begin to trade lower, you have it right here, right? And then of course you have to use the swing high, so we'll be using this high as a stop. Sorry, I'll fix it. You also have it here. With using this candle's high as the stop for framework, right? And I know most people who use fair value gaps, they like to frame their stops just above the candle that makes it, and I completely understand that too. And I put my stop above the swing high with the knowingness of knowing if it really is good, it shouldn't go past the candle that makes it. But sometimes this fractal can play out, but it'll run the high of the candle that makes the fair value gap, but never get to the swing high or the protected swing high, and then go lower. So I just lowered the risk and I encapsulate all of those logical areas that price can trade to, but still the trade still be good. And that just came with experience. And then so what we'll do is we'll mark out the possible targets. So whenever I frame my entries, I always enter at the worst case scenario for me as a trader. So this fair value gap, I'll be entering as soon as price get to that high, not the middle of the fair value gap, not any of the upper quadrants, not the very high of the fair value gap. I'm getting in at the worst case scenario, which would be that low. And my stop would have to be at the swing high. So that's 80 handles of a stop loss, right? And then I'm looking for 2 to 1. So 2 to 1, 160. Push you right here at the old new week opening gap, which is perfect, right? any of the quadrant levels, majority of the time I teach people, if you are grading a wick, if you're going to exit at the wick, always exit at the high of the wick, right? For, again, worst case scenario. Best case scenario would be if price ran out the low, completely traded through the wick and ran out the low. That's best case scenario. I'm always operating that worst case scenario whenever I'm using my entries and exits, and I would take the burden of greed and put less on the trade, right? And that allows me to take at the end of the day, it really allows me to take the most qualified and quality of trade and not be so focused on the risk that's actually on the trade and the greed of it. But again, so here we have it. You have this entry here. The new week opening gaps puts you out at 160 there, and then if you were to take the same here approach and getting at the high of the wick, that puts you there. Boom. Okay, now we have this fair value gap right here. Again, worst case scenario has me here. Stop has me just above, so 77. Okay, and then we're looking for 44. Boom. So 44 would have had you here. If you wanted to, you could just target the just above the wick level, right before that one level. That'll get you in right there. Again, 2 to 1, right? Here, stop here. So that's a 50. So you're looking for 100 on the downside. Does it offer it? Yes, it does. If you wanted to get out again at the wick, boom, that's there. And then this small one offers it too. I didn't have it because we're already so close to the new week opening gap, but that's another factor that played out for you too. Again, if you like videos like this, just recapping the morning session, please like, comment, subscribe, share. Also too, you will see majority of my trades that you can find in the ICT OTE pattern recognition series are essentially these entries here. So I'm doing it live. Here is just me walking through it in hindsight for the AM session. Thank you for watching. Talk soon.